All right, what's up guys? Magus here. Today we're going to do a video on market profile, also known as TPO, which is the abbreviation for time price opportunity. So what we're seeing here is the daily distribution. So think like a bell curve. Each one of these shapes is a day, and we're seeing where price spent the most time at. So the standard TPO settings are 30-minute blocks. So you can see each one of these individual blocks here within the day, and as time goes on, they're shaded. So the darker the block is, the earlier in the day it is, and the lighter the block is, the later in the day it is. Now, the standard way of doing it is to do the letters, so it goes through the alphabet A through Z. But I don't really like using the letters personally. It's just personal preference. But I do think people should probably start off with the letters because it makes getting understanding of these things maybe a little easier at first. But later on, I think you'll find out that for most people, unless you're really intraday trading with this, you're not really going to need to know exactly which order that block was printed in. So moving forward to what this is actually showing us. So like I said, this is showing us the distribution for the day. And ultimately, what we're trying to find with this is we're trying to find out what fair value is. Because as traders, that should be our goal, is to find out whatever asset we're trading. We want to know what the fair value is for that asset, because then that can help us make informed decisions, right? When price is below what fair value is, right, that's going to be presenting you an opportunity to take a long, and vice versa. When price is ahead of fair value, that's going to give you an opportunity to short. So with that said, um, ultimately what we're seeing here with the market profile is we're seeing the auctioning process, the back and forth. We're seeing the buyers and sellers trying to come to sort of an agreement for what fair value actually is. So that's mainly what I use this tool for, is to determine fair value. And on top of that, it gives me my levels that I can trade off of, as well as I form my bias through here. I can get some context from market profile, but ultimately that really comes a little bit more from the order flow, I'd say, than the actual profile itself. But there can be some context gained here. So just jumping into the anatomy of what it all is so that we can build off of that. So like I said, each one of these shapes represents a day, and the colors that I chose are just the colors that I chose. It has no bearing for when you guys make these yourself. But what you see is the center that is represented in green for mine is going to be what is known as the value area, which is where 70% of the time during the day was spent. Some people use 68%, but I think that more often than not, people are going to be using the 70%. That seems to be the standard, at least in my experience. So we're going to use this day right here as our example. The top green line, which is at the height of the value area, that's going to be known as the value area high, which is commonly abbreviated as the VAH, value area high. The low of the value area, you can guess, is the value area low, VAL. The center line, which is orange, is the point of control, which is the point where price spent the most time during the day. The purple lines that we see here are the initial balance, abbreviated as IB oftenly, which is the first hour of trading. And what that can be useful for is just it's great for bias, because that range that gets formed within the first hour of trading, right? When you trade below it or trade above it, that can often be very telling for what the rest of the day is going to shape up like. We're not going to dive too deeply into that yet. Apart from those are the main core components of the profile. Apart from that, we have some of the anomalies, which are going to be things like voids or singles, which let's see if I can cherry pick a good example of a single. The market's been relatively efficient. Okay, right, the Elon day, perfect example. So you have the start of the day, the open at pink here, and the close at red, right? And you started to have a pretty balanced distribution relative to the days before it, and then you got some explosive news that caused the market to shift into an imbalance and create a very ugly looking trend day. And we're left with these, what we call single prints, or also can be called as a void. It's also printed right here. And that's what these pink lines are signaling. And what that's showing us is that there was an absence of two-way trade, right? You have the explosive move where the aggressive orders chewed through any passive orders that were on the book and just blasted price off very quickly up, a couple $1,000 very quickly. And that is an anomaly because in a healthy market, you should have two-way trade where you always trade back and forth through the level. So in this instance, with the singles or the voids, you have an absence of two-way trade. Another type of common anomaly that we use is going to be singles or tails rather, excuse me. Tails are very, very common. I don't even need to cherry pick an example because I'm sure that there's just tons of them, right? What tails look like is they're just like the singles, except they're at the ends of value rather than being in the middle, right? Because a single needs to be within other blocks, but the tails are at the extremes. So right, we have a tail here, tail here, tail here, tail here, tail here. These are going to be commonly printed. They're very common to see, and price likes to trade through these to alleviate them. Um, and then the last one we're going to do is the poor high and poor low. And I don't really see any I mean, technically that's kind of a poor high. I normally would consider it to be three or more blocks. But what you're seeing is you want to see blunted prints at either the high or the low of the day. So that's kind of a poor high. But like I said, I really, kind of a poor high. But I really want to see three or four blocks. So this is almost, if you didn't have these two blocks here, this would be a poor low. These get cleaned up very often, so there's not going to be too many of them for me to find. But either way, it's a pretty simple thing. I don't really use poor highs and poor lows. The singles and the voids, right, and the tails. Personally, that's what I like to use a little bit more. But it's all personal preference. I'm just going to be teaching the ideas, and everyone needs to um, figure out how to make it work for themselves. So the last piece of anatomy that I want to talk about, I'm going to go ahead and zoom out so we can see more price so we can talk about it. I'm going to use this. This is a volume profile, and we'll use the volume profile for this. So we're going to talk about high volume nodes and low volume nodes. So HVN for high volume node and LVN for low volume node. So it's pretty straightforward, right? A high volume node is an area where you had a lot of volume transacted. Currently, where Bitcoin's trading is a high volume node, which you can gather a lot of information from that. I'll just what I will say is it is less likely to trade below this, right? But if it does trade below this, it's very quickly going to go to the next thing we're going to talk about, the low volume node, right? So you have the absence of volume here. When we zoom out a little bit, you can see that here's the Elon day, right? And before the Elon day, we had traded through this level or traded to the level. And when you have, oh, let's go back. Why are you doing this to me right now? Okay. This is a low volume node, right, where you have an absence of volume. Um, both of them serve as good points to pay attention to because the high volume nodes should be theoretically hard to get through because so much volume was transacted there that it's unlikely that it's going to get through it. But if it does make it through it, then it becomes a very high probability that you're going to continue in that direction, right? So that's where a tiny bit of my bullish bias comes from, right? Because we haven't been able to break through here. We've tried, but until we actually accept below this area that we're trading at now, I don't think you can really be bearish. Um, so that's a little bit on the high volume node. A little bit on the low volume node is just like I said, that there's the absence of volume, and how those are traded normally is that you're either going to very quickly going to come to it and bounce off of it, um, which is probably more often the way that you're going to want to trade them, I would say. But occasionally what happens is that when you don't get that quick response, right? When you come down to this low volume node and you don't get a quick response, what's going to happen is that price is normally going to fill in that void because that is an inefficiency. And in a healthy market, price does like to fill in the voids. Now, I'll use a quick segue to, the current environment. Since we're so heavily trend based, often we're not going to fill in inefficiencies because the market doesn't care. We're in such a strong trend. There's so much demand on our limited supply that um, often we're going to leave the inefficiencies behind. So I caution people, especially less experienced market profile users, that you want to pay attention and mark off the anomalies, but don't have any real degree of certainty, especially the further away they are from price. It's less likely that we actually fill them in. When we're in a ranging environment, you're significantly more likely to clean up all the inefficiencies and sweep them and fill them in or whatever. So um, I guess that's a good segue for me. I wasn't really planning on talking about this, but I do think it's really important. The main thing that I'm getting from market profile is that I'm able to determine my environment type for how I should trade because it's becoming more popular now that people are, at least in our space, people are finally realizing that there's two environment types to trade. There's the ranging bracketing environment, right, or balanced environment, where you're going to be more likely to be stuck within a range, and reversion is going to be how you're going to want to trade that. And then there's the trending or imbalanced type of market environment where you're going to be wanting to use momentum based strategies. So really the best thing that I'm getting out of this is that I'm able to be able to very quickly tell what type of strategy I should be using to trade that day because it's difficult because it is very discretionary and you kind of just get it or you don't. But since markets are always going to transition between the balance and the imbalance, that likely when you get a very imbalanced point, right? When you get a trending a period of strong trend, you're likely going to have a period of balance to follow it up, where the market's either going to accept that after that trend, we're either at fair value or we need to trend to a different point that's going to give us fair value. So, you know, kind of quickly, going back to the Elon day, right? We have our trend day, and following a trend day, what happens is that values get tight because we're going to try to seek balance, and the market is going to try to determine, is the price point that we're at fair value? Um, the market was really bullish. We said this is fair value. So what do? We mark up from there with some more trend days. We come into an area after some trend days. We try to form balance. The market, we try to determine, the market's going to tell us, is this fair value or is it not? The market clearly said that's not fair value, that this is above value. So what do? We get the trend days to follow, going down back to previous value. And now we're going to try to determine, is this fair value or not, right? Um, and it's just my opinion, but I do think it's pretty likely that we're gonna go ahead and mark up from this point eventually, because I think that we're gonna accept here and we'll mark up again, and we'll likely be able to smash the previous highs. Now, if I'm wrong and we accept below this area, I'm gonna take my losses and I'm gonna move on. I mean, that's just part of trading. But you need to be, believe in your bias. So what I will say is I'm not really going to talk too much about the idea of auction market theory because I've already made a video on that, and I'm going to do a tweet that links all this stuff together. But I think I'm going to leave you guys with that because I definitely just explained a lot there, and I'm just making up as I go. So if I decide that there's things that were left out, or if people ask questions, I might do a follow-up video on this. But just to do a quick little summarization of what we're gathering from this, right? I'm getting my levels, I'm getting my bias, I gather some context, but most importantly, I'm determining environment type with this tool, and that is enabling me to um, know what type of system to deploy, because it's very difficult for most traders to do that switch because a lot of us will trade momentum during momentum periods. We'll do well because of it. And then the range environment comes to follow, and we keep deploying the momentum strategy and we give back our gains. I see a lot of people tweeting about that all the time, and vice versa. Some traders are going to be better at the ranging environment, but they don't know how to transition when the trend comes to follow, and they can get blown out very easily because, if you're trying to mean revert when price is getting ready to accept above and do a markup or do a markdown, you're going to get blown out if you're not ready for that. So that's what I want to leave you guys with is environment recognition. Thanks, guys. Have a good one.